All right, our next guest has been called one of the most powerful women in finance. Liz Myers heads up J.P. Morgan's global equity capital markets business, which has led Wall Street in the number of deals and fees generated for nearly 10 years running. That's a good record, including Alibaba's blockbuster IPO and this year's top offerings, AXA Equitable and China Tower. Liz, welcome to Power Lunch, and Leslie Picker is here as well. Leslie, lead it off.
All right, well, I think a good way to start, and this kind of goes back to the entrepreneurship discussion that we were just talking about, the number of public companies in America has been on decline for about 20 years now, sitting at roughly 3,600 at the end of 2017. It's estimated that twice that number is in venture-backed and private equity-backed companies. We've seen 3 iterations of the Jobs Act trying to make the markets more hospitable for public companies, more hospitable for IPOs. What can be done? If you were talking to Jay Clayton at the SEC, what would you tell him that these companies need in order to get more of them into the public markets?
Well, I think we've seen some good strides out of the SEC so far, which is including more companies and the ability to file confidentially. So companies have a little bit more air cover if they're wanting to test the markets before they fully alert the market of their intentions to be public. So that's giving people more flexibility that I think is quite helpful. But I think the other reason is the private capital markets are very robust, and there's good access to capital for companies for quite a long time before they ultimately make the transition to the IPO. But we have seen a number of large software companies this year that have made that step from the private capital markets into the public, and I think that trend will continue where companies really do start to realize the benefits of that greater liquidity that comes from an IPO, both for their early investors and for their employees.
I'm suspicious that it's related to lower interest rates. Interest rates have literally gone down for 20 years, right? So as people get more and more desperate for yield, it sends money to parts of the market. I think there's a lot of money in venture capital that went there because it was desperate. And wouldn't we see more public companies if it wasn't so easy to get private money? And wouldn't it be easier? Wouldn't there be less private money if there were higher interest rates?
Well, I think of it as the private capital markets have allowed companies to become more sizable and more mature before they make it to the public market. So they ultimately are more successful as public companies. So that's not necessarily a bad thing. Interest rates rising, that can be the tale of two cities for the IPO market. If interest rates rise at a predictable pace, then we can anticipate that the equity markets will be calm and absorb that. If they rise too quickly, that can be a negative for equity investors and create volatility that can also impact the receptivity for IPOs.
And you mentioned internet, and it certainly seems like software is kind of the key word for many of the companies that are going public right now. I mean, I'm even looking at Sonos. It's up 25% today. It just started trading a couple hours ago. It's really a hardware company. They're selling speakers, but they've been pushing this narrative that they have a big part of their business is around software and their engineers are tied to software. Is that sort of the thing that investors are looking for right now? These internet companies, these software companies, is this the hot area in terms of IPOs?
Software has been a big part of the calendar year to date and will continue to be as we look towards the back half of the year. But technology, whether it be e-commerce, security, search, internet, there are many, many flavors that have provided great returns for investors. And across that broader swath, we've seen multiple IPOs this year that have priced $2 and $3 above the range, have traded up 30, 40, even 70% in the aftermarket. So high growth companies are definitely an area of great interest. And I would say investors are willing to dig in and not assume that any one particular model is the only choice.
What are you hearing about Saudi Aramco?
That is a topic I can't get into in great detail, but the energy sector continues to be an interesting one. Less issuance this year in the U.S. market than we've seen in prior years. But it's great to see the evolution in the Saudi Arabian economy towards a more open and accepting society, whether it be women driving and more freedoms for their individual citizens. But certainly,
I'm glad I stepped into an area you can't talk about.
The other $1 trillion plus company.
Not knowing.
Managed to do well.
Well done.